A 23,000% projected move, placing XRP near 315, is now being discussed in serious crypto research circles in 2026, not just on social media, not just by retail traders, but by analysts looking at liquidity flows, regulatory positioning, and the future structure of global finance. Now, before you dismiss that number as unrealistic, you need to understand something critical. This projection is not based on hype. It's based on a very specific scenario, one where XRP becomes deeply embedded in how money moves across borders. And today, we're going to break that down properly, where this number comes from, what needs to happen for it to become possible, and most importantly, why even if it happens, most holders still won't benefit from it, because this isn't just about price, it's about structure, and everything starts with regulation. Back in July 2023, the case between the U.S. Securities and Exchange Commission and Ripple reached a turning point. A U.S. federal court ruled that programmatic sales of XRP on exchanges did not qualify as securities transactions. That single decision changed the entire conversation. For years, XRP had been operating under a cloud of legal uncertainty, and institutions don't allocate capital into assets that might later be classified as illegal securities. That's not how large money moves. But after that ruling, the risk profile began to shift. By late 2025, legal analysts tracking federal filings and settlement progress estimated that over 70% of XRP's regulatory uncertainty had been resolved. Not fully gone, but significantly reduced. And that matters more than most people realize, because markets don't just respond to innovation, they respond to clarity. Without clarity, capital waits. With clarity, capital moves. At the same time, the global financial system is still running on outdated infrastructure. Cross-border payments, sending money from one country to another, still take anywhere from 1 to 3 business days to settle, according to international banking reports from 2024. That delay creates friction, it locks up liquidity, and it increases costs for businesses, banks, and governments. Now scale that problem globally. We're talking about trillions of dollars moving across borders every single year, and most of it is still inefficient. This is the exact problem XRP was designed to solve, not as a speculative coin, but as a bridge asset, a neutral intermediary that allows value to move instantly between two different currencies without needing pre-funded accounts. That's the key idea. Instead of banks holding massive reserves in multiple currencies around the world, they can use XRP as a temporary bridge, convert in, move value, convert out. Seconds instead of days. Liquidity instead of capital lockup. Now think about what happens if that system actually scales. Price is no longer driven by hype. It becomes driven by demand for liquidity. And that's where things start to get interesting, because while most people are watching charts, institutions are building infrastructure. And that's the signal that matters. Over the past few years, Ripple has been expanding its global payment network aggressively, not through headlines, but through partnerships. Banks, fintech firms, and payment providers across Asia, the Middle East, and Latin America have been integrating Ripple's technology to enable faster settlement corridors. And these aren't experiments anymore, they're operational systems. By 2025, analysts tracking enterprise blockchain adoption reported that Ripple's liquidity hubs were processing billions of dollars in transaction volume every quarter. That's based on corridor activity, partner disclosures, and network usage data. This is not theoretical, it's already happening, just not at full scale yet. At the same time, institutional custody has quietly evolved, and this is a piece most retail investors completely overlook. Institutions cannot hold digital assets without secure, regulated custody solutions. It's a non-negotiable requirement. By mid-2025, multiple institutional-grade custody providers began offering support for XRP alongside assets like Bitcoin and Ethereum. That signals readiness, because custody always comes before capital allocation. First, the infrastructure gets built, then the money follows. Now layer in another major development, central bank digital currencies. By 2024, over 130 countries representing more than 95% of global GDP were actively researching, testing, or piloting CBDCs based on international monetary data. That sounds like progress, but it introduces a new problem: fragmentation. Every country building its own digital currency, different systems, different rules, different technologies, and none of them are naturally interoperable. So instead of simplifying the system, CBDCs could actually make cross-border payments more complex. And that complexity creates a need, a neutral bridge between systems. That's where XRP fits into the picture. Not guaranteed, but structurally aligned. It's one of the few digital assets designed specifically for interoperability between financial networks. And if that role becomes critical, demand doesn't come from traders, it comes from systems. Now here's the part most people are missing completely. The real acceleration is not happening in the United States, it's happening in emerging markets. Regions where the inefficiencies of the current system are not just inconvenient, they're costly. In Southeast Asia, cross-border trade is expanding rapidly. In the Middle East, financial corridors are becoming more digitized, but the most overlooked region is Africa. Across sub-Saharan Africa, countries are dealing with fragmented currencies, limited liquidity, and extremely high remittance costs. In some cases, sending money across borders can cost over 6% per transaction, based on World Bank remittance data from 2024. That's not sustainable, especially in economies where cross-border transfers are essential for families and businesses. This is where blockchain-based settlement becomes practical, not experimental, not optional, necessary. Ripple has already been engaging with payment providers and financial institutions in Africa to explore faster, more efficient settlement solutions. These are early-stage integrations, but they matter, because adoption doesn't happen all at once. It happens corridor by corridor, country by country, system by system. And once these systems start using XRP as a bridge for liquidity, something fundamental changes. Demand becomes continuous, not driven by speculation, but by usage. And usage creates a completely different type of market behavior. Not sharp spikes followed by crashes, but sustained pressure driven by real-world activity. That's how assets transition from speculative to infrastructural. Now let's bring everything together. Regulatory clarity reduces uncertainty and opens the door for institutional participation. Infrastructure expansion shows that real transaction volume is already building beneath the surface. And emerging markets are where the demand for efficient liquidity is accelerating the fastest. Put those three forces together, and you get a scenario where XRP's value is directly tied to how much global liquidity it facilitates, not how many people are trading it on exchanges. Now let's address the big number, $315. Where does that even come from? It comes from modeling. If XRP were to handle a meaningful percentage of global cross-border liquidity, trillions of dollars annually, then the available supply would need to support that level of throughput. And since supply is limited, price adjusts, not gradually, but aggressively. That's why projections like 23,000% exist. They're not predictions. They're scenario-based outcomes tied to scale. But here's the reality check. This entire thesis depends on adoption. If banks choose alternative systems, if CBDCs become interoperable without XRP, or if regulatory environments shift again, this scenario weakens significantly. There is real risk here, and ignoring that risk is how people lose money. At the same time, the opportunity is equally real. If even a small portion of global liquidity flows through XRP-based systems, the market won't behave the way most investors expect. It won't be a slow climb. It will be a repricing event, and those are rare. But here's the final piece, and this is important. Even if XRP reaches extreme valuations, most holders will still miss it. Why? Because they're not positioned for the journey. They exit too early. They react emotionally to volatility, or they misunderstand what they actually own. This is not just an asset story, it's a behavior story. Understanding the system is one thing. Staying in position long enough to benefit from it is another. Now that you understand what's really driving these projections, the regulation, the infrastructure, and the global liquidity shift, the next step is learning how price actually moves in a liquidity-driven market, because it's not what most people think. If you're serious about understanding where this is going, the next video breaks down exactly how liquidity cycles drive explosive price movements, and how to position yourself without getting shaken out early. Subscribe so you don't miss that one.